macro currency signals.
There are moments in markets when the surface looks chaotic, but underneath, something far more important is happening. Red candles flash across screens. Commentators panic. Social media fills with declarations that the move is over. Traders scramble to explain volatility as if volatility itself is the story. But price is rarely the story. Price is the weapon. The story is what happens to inventory when the weapon is used. Because when the exchange raises margin requirements to extreme levels, most people assume it's bearish. They see higher collateral demands and think it signals the end of a move. But that assumption confuses short-term mechanics with long-term structure. Margin hikes do one thing above all else. They attack leverage. They do not attack demand. They do not eliminate scarcity. They do not increase mine supply. They do not reduce industrial consumption. They remove weak hands. And when weak hands are removed, ownership concentrates. That concentration is not random. It migrates toward balance sheets that can withstand volatility. Before we go any further, if this breakdown is resonating the way it should, make sure you're subscribed and that notifications are turned on. In environments like this, timing matters. Being early isn't a luxury. It's the edge. Drop a comment below and tell me where you're watching from and what time it is on your side of the world. This conversation isn't confined to one country or one market. It's global, and seeing how far this reaches says more than any headline ever will. Now understand what just happened. The cost to control 5,000 ounces of silver through futures has more than doubled in a short period of time. When margins rise from levels that were manageable to levels that demand serious capital, the leverage crowd suffocates. A trader who once needed a relatively small margin account to control a large notional position now needs multiples of that capital. At the same time, volatility is injected into the calculation. As price rises, the contract value increases automatically. When volatility spikes, the percentage required rises as well. That's a double compression. Higher price, higher margin, higher volatility component. And when that happens, forced liquidation becomes inevitable. But here's the critical distinction. Forced liquidation in futures does not mean liquidation in physical. The industrial user does not liquidate. The sovereign entity does not liquidate. The long-term accumulator does not liquidate. Only the leveraged trader liquidates. And when those leverage positions are forced out, someone absorbs them. That absorption tells you who is really in control. Because the day after one of the largest one-day drops in silver, something extraordinary happened. Tens of millions of ounces were added to an ETF structure in a single session. That does not happen by accident. That does not happen because retail investors panicked and suddenly bought millions of ounces collectively. That happens because authorized participants delivered physical metal to create new shares. In other words, physical silver was sourced aggressively during a futures-driven flush and moved into controlled custody. That is not bearish behavior. That is accumulation under pressure. And if you understand how ETF creation works, you understand something even more important. New shares cannot be created without physical delivery first. The metal must exist. It must be transferred. It must be custodied, which means that while price was collapsing on paper, metal was migrating into stronger hands in reality. That is the kind of divergence that precedes violent repricing. Now step back even further. We are not dealing with a silver market in equilibrium. We are dealing with 6 consecutive years of global deficits. We are dealing with industrial demand that continues to expand due to electrification, renewable infrastructure, military applications, data center expansion, and advanced technology manufacturing. Silver is not just a monetary metal. It is a conductivity metal. And conductivity demand is accelerating, not slowing. Solar installations alone have dramatically increased silver consumption per year. Grid modernization projects are expanding. Electric vehicle infrastructure requires significant silver usage. High-performance electronics rely on silver's properties. Substitution is limited because conductivity matters. Efficiency matters. Performance matters. When deficits persist year after year, inventories do not magically rebuild. They shrink. Above-ground stockpiles get thinner, and when inventories get thinner, the margin between supply and shock narrows. Now look at the exchange structure. Registered inventory, the category actually available for delivery, is a fraction of total open interest tied to major contracts. Yes, historically, most contracts roll forward or cash settle. But the stress appears when a higher percentage stands for delivery than expected. Even a modest increase in delivery demand can strain registered supply. And when registered supply tightens, price must respond, not because of conspiracy, because of arithmetic. You cannot promise what you do not possess indefinitely. If more participants want immediacy, actual bars, not paper, the premium for immediacy rises. That is how markets clear. And while all this is happening, something else is unfolding in the background. Silver has been formally recognized as a critical mineral. That classification is not symbolic. It signals strategic value. When a government begins building reserve frameworks for critical minerals, it is not doing so because supply is abundant. It is doing so because supply chains are vulnerable. Strategic reserves remove metal from floating supply. They place it into long-term storage. They reduce liquidity. They create a floor under demand, and when private investors compete with industrial users and strategic stockpilers for the same metal, elasticity disappears. That is when price behavior changes. Most people still treat silver as a trading instrument, but the structure increasingly treats it as infrastructure. There is a psychological lag between structural change and price recognition. Markets do not immediately reflect shifts in supply chain policy or strategic classification. They drift, they compress, they oscillate, until one day the oscillation fails. And when it fails, price gaps. Now consider the bond market. Global sovereign debt is at historic highs relative to GDP. Interest expense is rising. Fiscal deficits are expanding. If yields remain elevated, budget stress intensifies. If yields are suppressed, currency supply expands. Either path pressures purchasing power, and when purchasing power is pressured, hard assets absorb capital. Gold tends to move first. Silver tends to move harder. Because silver's market size is tiny relative to global capital pools, the total annual value of newly mined silver is minuscule compared to bond markets, equity markets, or foreign exchange markets. It would take a fractional reallocation of institutional capital to overwhelm available supply. That is not hyperbole. It is math. When capital moves into a thin market, price does not glide. It jumps. And when leverage has been purged beforehand through margin hikes, fewer speculative shorts remain to absorb upside momentum. That reduces resistance. Volatility during margin hikes feels destructive, but structurally it can be constructive, because the metal ends up in stronger hands. And stronger hands do not sell into minor rallies. They accumulate through noise. Then something changes. The narrative shifts. Instead of asking whether silver is too volatile, the market begins asking whether it is too scarce. Instead of debating resistance levels, participants debate availability. And that transition is when price accelerates beyond expectations. Now, about the number. $200 in 2 months sounds outrageous. And under normal market conditions, it would be. But the question is not whether it sounds outrageous. The question is what conditions would make it possible. For silver to move that aggressively in a compressed time frame, 3 things would need to converge: a delivery shock, a macro liquidity event, and a visible inventory strain. If those 3 align, if open interest stands higher than expected, if registered supply tightens rapidly, and if a macro event drives capital toward hard assets, repricing can occur in vertical fashion. Small markets reprice faster than large ones, and silver is small. When margin hikes eliminate weak leverage and concentrate ownership in stronger hands, upside moves become less constrained by panic selling. Add in industrial bid competition and strategic stockpiling, and the float tightens further. The key is not hype. The key is structure. We are in a structure where deficits persist, industrial demand rises, strategic classification increases, margin hikes purge leverage, inventory migrates to stronger hands, delivery pressure remains elevated. That combination does not guarantee a price, but it creates asymmetry. And asymmetry is where the biggest opportunities emerge. Not because the market promises them, but because the imbalance demands resolution. This is not about emotion. It is about mechanics, not about headlines, about arithmetic, not about fear, about structure. And when structure shifts in a thin market, expectations are the first casualty. This is the setup. For silver to make a vertical move in a compressed time frame, the market doesn't need enthusiasm. It needs imbalance. And imbalance is already embedded in the system. Start with this. The futures market is a price discovery mechanism built on leverage. It works smoothly when participation is balanced and delivery expectations are low. Most contracts roll forward, most settle in cash. Physical delivery is a minority event. But when open interest represents multiples of the registered metal available for delivery, the entire system relies on one assumption: that the majority will not ask for the metal. If that assumption shifts even slightly, pricing pressure changes immediately. You don't need every contract to stand for delivery. You don't need a default. You need a higher than expected percentage to demand immediacy, because silver does not have deep buffers. Registered inventories are not infinite. Eligible metal is not automatically for sale. Large holders are not obligated to convert eligible to registered unless the price incentivizes it. So what forces incentive? Spread tightening, backwardation, a rising premium for near-term contracts versus deferred ones. When immediate delivery becomes more valuable than future delivery, that's a signal. And when that signal appears in a market already experiencing global deficits, it becomes combustible. Now imagine this happening alongside macro stress. Bond yields spike unexpectedly. A regional banking issue resurfaces. A liquidity facility is announced. Markets suddenly reassess currency stability. Gold moves first. It always does. But once gold confirms that monetary stress is real, silver becomes the torque. Because silver sits at the intersection of monetary fear and industrial necessity, and when both activate at once, it doesn't crawl upward, it reprices violently. Here's what most people underestimate. Silver is a tiny market relative to global capital flows. The annual value of mined silver is insignificant compared to pension allocations, sovereign wealth funds, hedge fund liquidity, or global derivatives exposure. A single major institution reallocating a small percentage of assets toward physical silver exposure could absorb months of mine supply. Now multiply that by several institutions acting simultaneously under stress conditions. The math gets uncomfortable quickly. And that's before retail even wakes up. Retail always arrives late. The first leg is institutional. The second leg is momentum. The third leg is public awareness. If you ever see silver begin to move aggressively while mainstream coverage remains skeptical or dismissive, that's early phase behavior. If you see volatility expanding but inventories not rebuilding, that's tightening. If you see delivery volume remain elevated after margin hikes, that's conviction. And when conviction outlasts suppression attempts, repricing accelerates. Now let's talk about industrial demand under stress. Manufacturers do not have the luxury of waiting for price corrections when production lines depend on silver components. If price spikes, procurement departments hedge forward supply, they secure contracts, they increase inventory buffers. That removes additional metal from circulation, which tightens the float further. At the same time, if silver has been formally classified as critical, strategic stockpiling becomes policy-driven rather than price-driven. Governments don't wait for ideal entry points when they perceive supply vulnerability. They accumulate. That creates a bid underneath the market that does not trade emotionally. It accumulates quietly. Now layer on ETF dynamics. When ETFs receive large inflows during volatility, that signals physical migration. Authorized participants must source metal to create shares. If inflows coincide with exchange inventory tightening, that means metal is being transferred from weaker holders to stronger custodians. And if those custodians later redeem shares for physical metal, that metal exits transparent trading ecosystems. Opacity increases, float decreases, pressure builds. What would it take for silver to approach something like $200 in a short window? It would not be gradual optimism. It would be a convergence event. Delivery stress exceeding expectations, a macro liquidity injection that weakens currency confidence, industrial hedging that accelerates into strength, and visible strain in exchange inventories that forces repricing of immediacy. When those converge, price does not move in polite increments. It gaps. Silver has done this before on smaller scales. In prior cycles, it doubled or tripled in compressed time frames when conditions aligned. Those moves felt irrational in the moment, but they were driven by structural imbalance. Now consider the psychological layer. Most market participants anchor to prior highs. They look at historical ceilings and assume they define reality. But historical ceilings were formed under different supply, demand, and monetary conditions. If structural conditions change, anchors lose relevance. $200 sounds extreme because the anchor is much lower. But if currency purchasing power erodes and silver's monetary role reactivates alongside industrial scarcity, nominal price targets become less meaningful. It's not about whether the number sounds big. It's about whether the denominator is shrinking. And in an environment of fiscal expansion, strategic stockpiling, and industrial acceleration, the denominator is unstable. The other piece is leverage purge. Margin hikes, while painful, reduce speculative excess. Once leverage is flushed, upside moves encounter less forced selling. That allows momentum to build more cleanly. it becomes harder to suppress. Fewer weak hands, more conviction holders, and when conviction holders control more of the float, volatility tilts upward more easily. This is how vertical repricing windows open, not through hype, through stress. Stress in bond markets, stress in currency confidence, stress in delivery systems, stress in supply chains. When stress compounds across systems, capital seeks refuge. Gold absorbs the first wave, silver amplifies the second. And if that second wave coincides with tangible supply constraints, price acceleration can exceed expectations rapidly. The key phrase is can, not will. Markets are dynamic, but the setup is asymmetrical. The downside is bounded by production cost, strategic demand, and physical deficits. The upside, under stress convergence, is open-ended. And in thin markets, open-ended moves can compress into short timeframes. This is not about prediction. It is about preparedness. If silver begins to exhibit persistent backwardation, elevated delivery ratios, shrinking registered inventories, accelerating ETF inflows, industrial hedging in strength, and macro liquidity expansion, then the repricing window is open, and once it opens, it does not wait for consensus. Consensus forms after the move. By the time headlines validate it, the easy phase is gone. That is how asymmetric opportunities behave. They look unlikely. They feel volatile. They test conviction. Then they explode when the imbalance becomes undeniable. Silver is not just a chart. It is a pressure gauge for monetary stress and industrial scarcity combined. If that gauge spikes under synchronized stress, expectations will not merely adjust, they will shatter. And here's the part most people miss. Markets don't send invitations before they move. They don't wait for consensus. They don't pause so everyone can feel comfortable. When imbalance builds quietly for years and then something finally tips the scale, price doesn't negotiate. It reacts. If silver ever enters that kind of convergence, delivery stress, tightening supply, institutional accumulation, macro instability, the move won't feel orderly. It will feel shocking. It will feel too fast. It will feel unbelievable. And that's exactly why almost no one will be positioned for it. The biggest opportunities in decades never look obvious beforehand. They look volatile, they look risky, they look premature, until suddenly they're not. And if silver's structure continues tightening while the world grows more unstable, the question won't be whether the move seems extreme. The question will be who understood the imbalance before it was visible to everyone else.